Hi, this is Rajat Bose talking to you once again. This is our fresh episode of weekly stock recommendations, stock review and the market outlook. This time what we have done is that we have combined three things. The regular market outlook comprising three indices as well as the stock recommendations, and from this time what we have done is that we have introduced stock reviews also within this program. That means now we are going to do two stock reviews in each episode that we have already given earlier, and two fresh stocks as new recommendations apart from the index based market outlook. First, we are taking the Nifty. It is a phenomenal week for the Nifty, from 18,650 kind of levels to 19,200. So you can guess that there had been a huge run up of 550 points. Mind you, this week was a truncated week. Up to Wednesday, 3 sessions, then Thursday was a holiday due to Bakrid, and then Friday. So within these 4 sessions, we have seen a huge run up. On Monday, the 9-day exponential moving average of the Nifty was around 18,730. That needed to be crossed. It did that, and that was the level after which we saw the Nifty moving up. Nifty moved up. After that, Nifty moved up with gaps. From Tuesday to Wednesday, from Thursday to Friday, we have seen gaps, and they were big gaps. During the week, we posted a new high. We posted a new high above 18,887, and we also posted 19,000 plus levels. 19,000 plus levels were crossed. Then we also crossed a significant resistance level which would act as a support level from here on, that is 19,125. Finally, the Nifty closed at 19,189. 19,189 has been the Friday's close. We are going to see a lot of momentum, because what was supposed to be a corrective swing, actually what happened is that foreign portfolio investors have started buying in such a manner that as if there is no tomorrow. So buoyed on their buying, the Nifty also moved up very strongly to close at 19,189. So we are going to discuss the charts. Based on that, we would show you the projections that we can see. Now only projections will come because Nifty is already in all-time high territory. From the last 75 minutes of 26 June, the up move in the Nifty began. Initially, there had been some hesitation, but from Tuesday 27 June, about 1 p.m., the index simply never looked back. You'll notice that from then, only one red candle in the mid-session on Wednesday, June 28th happened. Else it was all green candles. It was a hugely bullish rally with a lot of gumption till the last 75 minutes on Friday, 30th of June. It clearly shows that there is a strong momentum, which in all likelihood will continue in the coming week. Now, when you look at the 1-year daily chart of the Nifty, you find two successive gaps on Wednesday 28th June and Friday June 30th. Thursday, of course, Thursday 29th June was a holiday on account of Bakrid. The index displayed the strength and the courage of the bulls despite the fact that it was the all-time high level we are going through. When the market closed on Thursday on such strong notes, lots of people thought that it was due to month-end clearing of the derivatives induced short covering. However, it was clearly the sheer bullish gumption that was at play, and it became very apparent when the early morning gap up opening on Friday 30th June was never filled. The gap was simply never filled. It was a huge buying that led to this kind of an upsurge. Now we look at the weekly chart. On the weekly chart, you see that since the beginning of this rally, you find the first green candle showed a range of 467 points. It was around April when in a week it moved up by 467 points. 24th April, the week starting, we saw this green candle. Then thereafter, in the middle of this rally, this 3-month or say 2.5-month rally, there was another green candle of 477 points. While the last week's candle, that is the June 26th to about 30th June, this period, although it had only 4 sessions, not 5, because there was a holiday, this one was the longest range candle, 555 points. This, in all probability, indicates a continuation of bullishness over the coming week. Now, the level of 19,125 would act as a support, while on the upside 19,257, 19,374 and 19,532 are the projected Fibonacci resistance levels that may bring in some supplies. So let's see what happens. Bank Nifty posted an even greater performance. This was something I did not anticipate. I was anticipating that Bank Nifty would at least test the 43,000 mark and test the zone between the major support zone between 43,000 and 42,800, but that was not to be. Bank Nifty started moving up from 43,400 levels to 44,000 plus levels. 44,500 was taken out, and it was kind of a 1,500 plus points move during the week. However, one thing I would like to remind you, in all these days, whenever I came before you to give you a commentary on the Bank Nifty, I was always telling you that even last time I emphasized over it that 43,000 to 42,800, unless that is taken out on the downside, the intermediate uptrend of the Bank Nifty would still be in operation, and whatever is happening would be considered a course correction. Exactly that has happened, and especially in the last week when we saw kind of a sideways movement, that was a signal that Bank Nifty could be in for a good movement, but unless we get a confirmation, I cannot vouch for that. This time that confirmation has come. Again, here also you see a lot of gap up openings, and the bodies are small, sometimes the tail is longer, yet Bank Nifty did not budge at all. The Bank Nifty bulls took it to beyond 44,500. Maybe we are heading towards 45,000 plus levels. We will discuss all that in details in the charts. There will be 3 types of charts: 75-minute chart, daily chart and the weekly chart. When you look at the 75-minute chart, up until the end of the week ending 23rd June, and also on Monday 26 June, it was very tentative, and the weakness signs in the form of a potential distribution were all too apparent. However, the whole thing took a 180-degree about turn come June 28 noon time. After that, it was all round buying, only not to look back at all. That began on 28 June, Wednesday, mid session. It was an upswing from 43,720 to 44,421, a gain of cool 700 points. Simply phenomenal. After that, the bank bulls turned a bit circumspect, and we see that most of these 75-minute candles, look at the top, the candles showed below the halfway mark endings. That means the whole candle, the total depth of the total length of the candle, it was actually ending at the bottom one-fourth, bottom quartile. This is in sharp contrast to what was happening in the Nifty. So Bank Nifty still displays a bit of a hesitation. The 1-year chart of the Bank Nifty shows that while it was trying to match the performance of the Nifty, it was faltering. It was faltering there a bit in the form of hammer lines and spinning tops, which are arguably the signs of impending weakness again. However, till such time, the 9-day EMA level of 44,091, that is 44,091, gets violated, all the dips are likely to be bought. We have seen that earlier also. That's why unless those levels are broken, we are not going to take any negative view on the Bank Nifty. In fact, the best is yet to come till we look at the weekly chart of the Bank Nifty. Look at the weekly chart now. What you see is, following a hiatus of 7 weeks, we see a huge green candle encompassing 1245 points, 1245 points. It was as if the bank bulls were busy compensating for the last 7 weeks of nonchalance. Last week, we thought that if there were to be a breakdown of 42,800 for the Bank Nifty, then this index would become bearish. This week, it has to be raised to the 9-week EMA level of 43,697 or 43,700, roughly speaking. Till such time 43,700 mark gets broken on heavy selling, all dips are likely to see fresh buying coming in. cnxmidcap has posted an 1100 point rally this week in 4 sessions. Gap up sessions, gap sustained and posted a new high, finally closed at 35,750 plus levels. So cnxmidcap only gave a couple of days correction, and after that it was on the 3rd day, that is Monday this week, after the 2-day fall in the week prior to the last week, it did go down to 34,659. From there the movement happened on the upside and it was an 1100 point run. So it was a phenomenal run. And we are accustomed to this kind of a phenomenal upswing, but this time the gradient is pretty strong, pretty high, and the momentum is all too powerful. So we would discuss it in detail using the same 75-minute, 1-day and weekly charts. The most critical level for cnxmidcap 100 index is located at 35,522. This level should not be violated on closing price basis for the continuation of strength in this index. It will remain bullish, strongly bullish, if it were to maintain above 35,522 mark. Initially, for the support to this index, we have another level to watch out for, that is 35,744. This is the level of the earlier high on Wednesday 21st June. After that, there was 2 days of sharp fall in the cnxmidcap. However, cnxmidcap now breached that high of 35,744 and posted a higher close. So as of now, so long as the 9-day EMA level of 35,277 gets taken out, all dips are likely to see renewed buying. It is only when 34,828 through 34,659, this range, this is a very important range, this range gets pierced on good volume, the index would give a bearish signal. So 34,659 low of this index demands our attention. For any break, any serious break of this level would mean cnxmidcap would be showing bearish signals. The 1-year chart, if you look at it, on the upside, the range between 36,374 and 36,505 would most likely act as the potential resistance levels for this index. This zone, that is 36,374 to 36,505, might act as a supply zone for the index. Once this range is taken out on high volume buying, the next target will be 38,384. That is a cool 2,000 points away, because it is in the it is in the blue sky territory. So that's why the next resistance level, which is a projected target level, comes at 38,384. As of now, to conclude, we would say that the CNX Midcap Index looks strongly bullish. As promised, now we are introducing stock reviews also within the regular episodes. What I would do is that I would review two stocks starting with I, and these two stocks I have discussed about a month or so back. So first I take up IDFC First Bank. IDFC First Bank, we took it up at 69 and our stop loss was about 60, and the target levels given was 73, 79, 84, 85 and 92. Phenomenal performance from IDFC First Bank. First two targets were met. The third target was missed by the stock for only 50 paisa. In this upswing, the last upswing that we saw, IDFC First Bank posted a high of 83.50, and after that it is consolidating. On Friday it closed at 79.40. I suggest you to continue holding it. Hold it. It will meet all its targets. Two targets are left, 85 and 92. Those two targets will be met. If they are met, you can book part profits. And now what I suggest is a revision of the stop loss. Now the stop loss should be around 68. Your stop loss should be around 68 and you carry on with the position. The charts will give you the details. What you see now on the screen is the year-to-date chart of IDFC First Bank. You can see that the rally that happened from mid-April, from a level around say 52 or so, it continues up. It touched a high of 83.50 and then it came down to test levels close to 75. It tested the 20-day exponential moving average, and after that it has started moving up again. It has closed at 79.40 on Friday, June 30th. I would suggest you to continue to hold on and put a stop loss now below the 70 mark on closing price basis. After the stock was recommended, it went up to a high of 83.50. Our targets of 75, 79 and 84, only the 84 target was missed by 50 paise, and the final target of 92 is still to be done, but I am confident that the stock will move up. It will cross 84, it will even cross 92. If you patiently hold on to it, it would get into triple digits as well. That's what I tend to expect about it. It is my conviction that this bank stock will do very well going forward, but you should maintain the stop loss of 70 as I just said. ICICI or ICICI Lombard General Insurance. Last time when we posted so many stock reviews, a lot of people have said that why I did not take up ICICI Lombard, because it did a phenomenal run. Yes, it did. It did a phenomenal run, but I must tell you that it did go down, hit the stop loss, but as I always mention to you, always make you remember that if stop loss gets hit, you exit, but once the trend resumes, the uptrend resumes, re-enter. So on re-entry, assuming at least the YouTube feedbacks are such that I understand that either people have held on or they have re-entered, so for them it had been a phenomenal performance. Our targets, all the targets were met because the targets were up to say 1200, and those targets have been met. Currently it is at 1344.45. My targets, I am giving you two targets for this, 1435 and 1580 going forward, and keep a stop loss of 1195. Since currently it is trading at 1344, so 1195 should be your stop loss, which is higher than the last four targets. So carry on with the position. You can expect good movement on this. It has closed on Friday at 1344.45. Our targets had been up to 1197 and all those levels have been met. Now it is headed higher, it has moved up, but one thing I must mention out here is that when we gave the recommendation, after that it failed, it stopped out, and on renewed buying, second time buying, repurchased position, it has actually given a brilliant run. And going by the YouTube feedback and also feedback through other media, I have come to understand that people have actually held on or re-entered. So for them, this is actually giving very good profits. Continue to hold on. The targets going forward would be 1435 and 1580. Now that the stock is ruling at 1344, I suggest put a stop loss below 1260 on closing price basis. So carry on with ICICI Lombard General Insurance Company. If you have liked my presentation, don't forget to press the like button. Subscribe to my channel. Also share this video with others if you liked. This week, at least towards the end of the week, there has been a reversal in tech stocks, especially the leading tech stocks, be it TCS, be it Infosys, be it others. There had been a good movement. I have chosen TCS for my first recommendation. TCS has closed at 3302 on Friday. In Friday's trading, it showed a good momentum. The momentum was such that, believe it or not, when I discussed the Bollinger Bands, the 20-day Bollinger Band is the basis, that is the moving average, the basis upon which the two Bollinger Bands are constructed. The +2 standard deviation and the second, the lower one is the -2 standard deviation. So this is the rare event where TCS, from the level which is below the 20-day moving average, it went beyond the upper Bollinger Band on Friday. This actually gave a strong buy signal, and that is what I am recommending for you. TCS has already taken care of certain developments, adverse developments in the company regarding its HR practices. So those things are a past. TCS has started moving up, and TCS is likely to continue moving up. So my targets are 34.40 and 35.50. I am expecting from the current levels, I am expecting that it will attain these targets within a month or so, maybe even 2 weeks to about 4 weeks time. It will take. 35.50 is a strong resistance zone, so that's why I have kept a target of 35.50 for TCS. Your stop loss should be below 31.50. In a time frame of about 1 to 2 months, these kind of levels may come. Actually, TCS, there is every possibility that TCS might cross the earlier high and move towards 3,900, 4,000 going forward. So I would recommend buying TCS at current levels. This is a fast recommendation, and I'm pretty much confident that TCS would do well. The chart that you see, or rather the screen that is being shown to you, is taken from tijorifinance.com. Here you can see that the return on invested capital, return on capital employed, that are pretty good, and TCS is still doing well. Currently it is hovering at a P level of about 30. EV to EBITDA has come down, but still a very comfortable 20.75. So even from a fundamental point of view, it has consolidated. It is now going to move up. The other IT company that I am recommending is Coforge. Coforge is known for its good performance. Coforge, after posting a high, there had been this year there had been a downswing, and then there had been an upswing, and this upswing is when this upswing happened on the weekly chart, the 200-week moving average was never taken out. So Coforge closed at 47.11. This time I have given a target up to 6,000. Your stop loss would be 42.89. 42.89 on closing price basis. It's a 400 rupees stop loss, but mind you, I am giving you a target which is 1,200 rupees away from the current level, and it's a long-term recommendation. Initial targets are, short-term targets are 5150 and 5500. After that, 5800 to about 6,000 levels would be scaled up. I anticipate it to scale up to those levels of 5800 to 6,000. Here I would suggest that you buy this stock for 1 year. Of course, you can also buy TCS for not just 1 year, you can buy for even longer term, 5 years. That is also possible, because TCS is a well-known blue chip and Coforge is an emerging blue chip. So both you can keep in your portfolio for longer term. Maybe the target could be met earlier there, and your stop loss would be 42.89 on closing price basis. Thank you for being with me. It was a phenomenal week, and we have already covered 2 stocks, new stocks, as well as 2 stocks review. Meet you next week.